In this video, I'm going to go ahead and work through the Brewer example, and we'll do the ECI example as well. Those two are at the back of your Module 8 notes. So when we're working this, of course, we need a comparative balance sheet because remember, there are certain accounts that we don't need to know exactly what went on during the year. We just need their beginning and ending balances. And those, of course, would be the the current assets, the current liabilities, the operating accounts that will feed into our cash flow from operations. So one of the first things you might do is just go ahead and note the changes in these accounts. Our accounts receivable increased by $25,000. Our inventories increased by $5,000, and our prepaid expenses decreased by $5,000. Remember, these will be individually assessed in my cash flow from investing activities. Although there may be some information in accumulated depreciation that I'll have to dig out, as we saw in class, sometimes that information in accumulated depreciation will help me figure out depreciation expense. So we'll come back to that in a second once we start constructing the statement. We then look at our current liabilities. Accounts payable went up by $10,000. Notes payable didn't change. But remember, even if it had changed, notes payable is a cash flow from financing activity. It's one of those rare accounts that doesn't fit the current liability, current asset rule. Accrued expenses went up by $5,000. So now we have those changes, and then we've identified some items that we might need to look more into. Again, accumulated depreciation for the depreciation expense. Notes payable would be a financing activity. And then, of course, long-term liabilities, equity, are cash flow from financing activities. Okay. Don't expect the balance sheets to be laid out quite as explanatory as this, identifying current assets. Part of your challenge with the statement of cash flows will be incorporating your knowledge about the balance sheet in order to determine what is a current asset and what's not a current asset. Of course, then we look at our income statement, and then we kind of identify the salient or important items here. We would be looking for depreciation expense, but we see that it's not there. So that means that we're going to have to use accumulated depreciation accounts in order to infer depreciation expense for the period. We do have a gain on the sale of a building, which obviously means I'm going to have a sale. So this is something that I want to think about for my CFO and my CFI. Right, I want the sale price in my CFI, and I also need to reverse that gain in my CFO. Same thing with the loss on land. That's going to be a CFO item. I want to reverse the loss, and a CFI item. So, go ahead and flag that. Make sure that you remember what you need that item for, or what it should spark in terms of, I have a sale of land. I need to record some inflow of cash from that sale. Then, of course, we look at our additional items, this sort of explanations that will fill in the blanks where necessary. I have that common stock was issued, a building was sold. We already knew that from the gain. Land was sold. Again, we knew that from the loss. Land was purchased for $50,000, and we'll see where that might fit in. No equipment was sold during the year. So go ahead and jump into your CFO when we have the cash flow from operating activities. And again, what we're doing with the operating activities with an indirect method cash flow statement. We begin at net income because we want to turn net income from an accrual and cash-based number into a number that is strictly cash-based. We start off with net income of $5,000. Then so you note that, and you would have your starting point. Okay. The depreciation, the non-cash expenses, are the next place you would want to go. But again, remember I said you don't have depreciation expense. You're going to have to figure it out. So the way I'm going to figure it out is by looking at that accumulated depreciation information. Just going to make some side notes over here. The accumulated depreciation for the buildings went from 40 to 50. And notice all the stuff we're bringing in now. Accumulated depreciation is a credit account. It started at a $40,000 balance, went to a $50,000 balance. Remember, any credit we make here, this is the beginning of the year, this is the end of the year, must correlate to the depreciation expense I recognized during the year. You would know that because of the very typical journal entry used to record depreciation expense. You can't just assume that it was $10,000 though, because you sold a building. So remember, the sales of items go over here on the debit side of the T account. It says, I sold a building which cost $50,000 and had accumulated depreciation of $10,000. So once I start identifying that, go ahead and start writing that journal entry. If I sold it, unless otherwise noted, I got cash. Remember, when we sell something, we need to zero out the accumulated depreciation account for it. That's just part of that journal entry of the sale. That's why I stressed it so much in the beginning of class, in the beginning of our class, back in chapter 1 and 2. It had a historical cost of $50,000. And I also know that I made a gain on the sale of that building. And that gain was for $20,000. So as soon as you know you have a gain, you might just go ahead and put it over there, right? Because I need to reverse the gain. So the gain on sale of building needs to be subtracted out of my net income because I don't want to double count it. Now I can go ahead and solve for the cash. That won't be used until the cash flow from investing activities, but that's all right. $50,000, $20,000, and so I must have sold the building for $60,000 of a cash flow. That's going to go to my CFI. What else do I know? I debited accumulated depreciation by $10,000, and so I would debit the accumulated depreciation account for buildings by $10,000. So 40 minus 10 would be 30, which means that then I have to have a $20,000 depreciation expense here as the amount that I recorded during the year. And that's not the only depreciation expense I had because I also have an equipment account. So I have accumulated depreciation for equipment. I'm going to go through and look at what goes on here, 15,000 to 15,000. I'm sorry, 15 is the beginning, 35 is the ending. Now, one of my notes said I didn't sell any any equipment during the year. If I didn't sell any equipment, then I didn't write off any accumulated depreciation, which means that this entire $20,000 change must have arisen from depreciation expense. So now I have a depreciation expense for equipment, a depreciation expense for buildings, and those two added together give me the amount of depreciation expense I'd want to add back. There are no other depreciable assets, so I don't have to worry about that. One of the things I said that I didn't expect you to know necessarily is the amortization expense, because patents were reduced by 10,000. And what that reflects is some amortization being charged. I wouldn't expect you to intuit that or calculate that from the change in patents. But if I have an amortization expense in the income statement, you should know that that's a non-cash activity. That is related to depreciating my intangible assets. So we add that one back as well. We had one other item, if you recall from the income statement, we had a loss on the sale of land, and that loss on the sale of land was given to you. At $10,000. We want to reverse it, and so we add it back. Now that I've taken care of all those items, the only thing that's left to deal with, in this case, is just the change in my current assets, my current liabilities. So from our notes on the Brewer statement, we had an increase of $25,000 in my accounts receivable. If my accounts receivable go up, that reflects credit sales that I made that don't have cash involved. And so I need to take that out of net income. In my inventories, they also rose. And that's going to lead to a $5,000 reversal there. My prepaid expenses fell. And because those fell, I want to add them back. Again, the idea is that if they fell, I expensed some of those prepaid expenses, but when I expensed it, I credited an asset account, not cash. And so that expense then needs to be added back to net income to get me to a cash flow number. My accounts receivable increased. My accounts payable increased. And if my accounts payable increased, that means that I recorded something that didn't involve cash. And so I'd want to add that back. And my accrued expenses also increased. Similar to the thought process behind accounts payable, I want to add that $5,000 back. So I take the sum of all these items. And then if you sum all these together, you should get $35,000. And that's my cash flow from operating activities. Okay. Now that I have that, I can move on to cash flow from investing activities. I'll just shorthand it CFI here. Going through this cash flow from investing activities, remember we flagged a couple of things we want to look at again. We had a sale of a building, and we had to sell some land. So anytime you have gains or losses on sales, that's a great way to know. I'm going to have to account for this again in cash flow from investing activities. We already calculated the gain, or the cash from the sale of the building, which was a receipt of $60,000. Now the sale of land was a little different. It said I had land with a cost of $25,000. So we wanted to credit it for its historical cost. It was sold for $15,000 cash. Oops. So we have $15,000 of cash, and that creates the loss that I've already reversed. Everything works out, adds up, so I got $15,000 of cash for the sale of that land. Now we have to determine if there were sales, then let's make sure that the T accounts are balanced by those sales. If there's some missing information, that might mean that I have a purchase. So I'm going to look through my T accounts with the building. My building started at a historical cost of $175, and they increased to an historical cost of $200,000. Well, I sold the building for $50,000, so that credit goes into the building account. Now, that doesn't balance any longer. I had 175, I decreased it by 50, I'm up at 200. That doesn't work out. So I have to increase this now by 75 as a purchase, and that would mean that I purchased a building for $75,000, pretty cheap building. That would be a cash outflow. Do the same thing with land. I had land. My land account started with a historical cost of $75,000, went up to a historical cost of $100,000, but I sold land with a historical cost of $25,000. So then I must have had $50,000 of purchase with land. So that purchase of land is a cash outflow of $50,000. Do we have anything else going on in my cash flow from investing activities? Well, the only other thing could have been a patent. If I had more stuff going on with the patent account besides this amortization, then you would have something going on. Like maybe you purchased a patent, maybe you sold a patent. If I sold a patent, you probably would know something about it because I'd have a gain or loss on it, or I would have some extra information about it. But we don't have any of that. So we can assume that this is now the closing of my cash flow from investing activities. The final item is, of course, cash flow from financing activities. And then here again, I want to look at my equity accounts, my long-term liability accounts. My long-term liability account, bonds payable, it went down by $30,000. If it went down by $30,000, then I would have a retirement of, I'm sorry, it actually went down by $40,000, not 30. I don't know what I'm saying. So we look at this bonds payable, it went down by $40,000 down to 100, which means I must have retired some bonds. You don't have any information about a bond issue. And so you can assume that we just retired $40,000 of bonds. If I retired them, that means that I paid money in order to bring down my outstanding liabilities. And so that is a cash outflow. The other item is that I issued some common stock. Now, I issued common stock, but notice also that my capital in excess of par rose as well. So if I look at what must have happened, a credit to common stock, a credit to common stock in excess of par, which is just additional paid in capital, another name for that account. I have two movements, one for 30, one for 10, which means that the overall cash that I received for that issue was $40,000. So I issued stock for $40,000. Now the final thing you need to check is for dividends. Were there any dividends? You look at the retained earnings section for any dividend payments by reconciling the beginning and ending balances. It started at $30,000, ended at $35,000. Supplement net income to figure out whether there's anything missing on the debit side. Net income was $5,000, which would increase my retained earnings by $5,000. And so there must have been no dividends declared. No dividends declared, no dividends payable accounts. Therefore, no dividends were paid. So then I sum up my three sections, 35,000, 75,000, and then 0. I have an overall cash outflow of $45,000. Does that reconcile my beginning and ending balances of cash? I'm sorry, that overall cash outflow is 35 minus 75, which is actually 40, not 45, which does work, right? 45 down to 5 gives me that down of 40, which is my check. Right, so that's Brewer. Look over this. If you have any questions about my process, how I did it, then please mention it in class. Any piece of this could be on the exam, any of these accounts, and I might even have a bonus opportunity for you on Monday if you can correctly reconcile an accumulated depreciation account, or tell me how much buildings and lands were sold for, or maybe a dividend payable. So work through those, make sure you're sharp on it. And if you watch this video, good for you, because you know something that people who don't watch the video will not know. Now let's look at that extractor claw example. The extractor claw example if I can find it myself. This one's just, it takes the basic example we worked in the class, adds a couple of bells and whistles to it. Again, I kind of want to analyze things just to get a feel for what's going on. My accounts receivable fell by 7,000. My inventories rose by 70. My accounts payable fell by 14. This rose by 5. Short-term notes payable should not be in my reconciliation of current liabilities, nor should dividends payable. Right? Then I looked through the income statement, tried to dig out some pertinent information. Good, I have depreciation expense, which means I don't have to dig through accumulated depreciation to find it. Although I could still probably use it when I'm determining how much I sold some items for. So don't just totally discount this account, right? In fact, look, depreciation expense was 10,000, but my accumulated depreciation rose by 7,000. So there's a bit of a difference. I must have sold something because my depreciation expense doesn't totally reconcile that account, right? If you draw just a little T account, you can figure that out real quick. 75 to 82. The 10,000 I recorded would be a credit, which doesn't balance. I must have had a 3K debit. So that must have come from a sale. Look through your gain, your loss, right? Means that I sold some plant assets, means that I sold some land. So that's some stuff I'm going to have to be aware of. Now down here, I've changed some of the information with ECI. I said I purchased $18,000 of land. I paid $14,000 in cash. I issued $1,000 of common stock and $3,000 of additional paid in capital common stock. So that would be a journal entry that I could make where I have land for $18,000 being debited because I purchased it. I paid cash of $14,000 and the rest was a common stock issue. It balances. It informs me that this was a cash outflow from investing activities and that this is a non-cash equity increase. So I'm going to have an overall increase in my equity, and I'm going to have to remember that 4,000 of that wasn't issued for cash. I also say that ECI purchased $40,000 of plant assets. I will shorthand it PA for $40,000. They paid cash for 70%. 70% of that would be 28, and 30% then would be long-term bonds payable. Again, I get a little bit of information in two places. One, I know that I had cash outflow from investing activities equal to the 28,000. The bonds payable is a non-cash investing activity. So bonds payable will go up by a certain amount or down, but I have to recognize that 12,000 of that effect was non-cash. Then I say ECI paid off $8,000 of long-term bonds payable. I know that I'll need that for my cash flow from financing activities. So again, mark up the problem a little bit, figure out what you know, what you don't know, make some journal entries, some preliminary analysis, and that will help you when you're filling out the statement of cash flows. So I start off again with my cash flow from operating activities. And that always begins with net income when I'm using an indirect method, because I need a starting point to start converting to cash flow from operations. $19,500 is my beginning net income balance. The next item would be depreciation expense that I have to add back. And I was kind enough to give it to you this time for $10,000. The next would be to reverse gains and losses. So I want to reverse the gain on the sale of plan assets. It was a gain of 8,000, so I subtract 8,000. The loss on the sale of land would be added back. I got those, and then again, just have to start working through my current assets and current liabilities. My accounts receivable fell, which means that I must have collected more cash than I made sales. So I would increase that, or show a cash inflow, increase net income by 7,000 because net income is not aware of my cash collections. Inventories increased by 70,000. An increase in inventory would be a negative adjustment to my net income. Wages payable decreased. I'm sorry, my accounts payable is the one that decreased. Got ahead of myself. Accounts payable decreased by 14,000. If they decreased by 14,000, that must mean we paid cash in order to bring that liability down. And net income would not have been aware of that, because there was no revenue, expense, loss, or gain. Wages payable would increase by 5,000, which probably is reflective of the fact that I have some expense, wage expense, that I didn't pay. And so it reduced my net income without a cash flow. Therefore, I need to add it back in order to show an appropriate cash from operating activities. I go ahead and compile these effects and get an amount for my cash flow from operating activities, which should amount to negative 47,500. All right, so it wasn't too hard here, right? Didn't do a lot of reconciliations, but don't worry, CFI and CFF will give us a lot to chew on. So the CFI, remember, I had a couple of things I noted right away, that I had a purchase of some land, I had a purchase of some plant assets, but only $28,000 and $14,000 of cash used. There was some non-cash stuff used. I only want to record the stuff that was paid in cash. So I would have an outflow of $28,000 for the plant assets. I would also have an outflow from the purchase of land. The purchase of land would have a $14,000 cash outflow. Then I have to decide what I sold, or if I sold. I know I sold because I have gains or losses on sale. Well, I need to dig around a little bit to get some more information. If I have my plant asset account and I purchased plant assets for $40,000, didn't use all cash, but my plant assets started at $260. They ended up at $274. Now that looks like I might have just bought $14,000, but I know that's not true. I know that I purchased plant assets. Now be careful here, not just for $28,000, but for $40,000, right? That's the amount I would have put into my account because that's their historical cost. Now, on the flip side of this, how much did I sell? Well, that's $260 plus 40 is $300, but I ended up at $274. So I must have sold $26,000. This is the historical cost, not the cash I received. So if I have plant assets being credited for $26,000, I also know that I had a gain. I had a gain on the sale for $8,000. What about accumulated depreciation? Remember way back when I said, yeah, you have some accumulated depreciation information, It didn't match up with the expense. I must have sold $3,000 of accumulated depreciation. Well, plant assets are the only thing that would have accumulated depreciation. Land does not. So that accumulated depreciation must have come from those plant assets. Which means then I can determine the amount of cash that I sold the plant assets for, which must have been $31,000. So then I sold plant assets for $31,000. Now, what about that sale of land? I know I had a loss on the sale of land. I don't know how much cash I got for it. So then we have to look at the land account. The land account started at a balance of $35,000. It ended at a balance of $43,000. If I sold land, or I'm sorry, I know I purchased some land for $18,000. Again, don't go with the cash flow here because there was some non-cash stuff that went into that purchase. I recorded at its historical cost whatever I gave up to get it. That would be $53,000, 35 plus 18, but I end up at 43, which means I must have sold land for $10,000. If I sold land for $10,000, then I can start to construct the journal entry. I have a loss on the sale of land for $3, and I would have a cash receipt of $7. So I would then have a sold land entry, and I would record $7,000 for that. So then overall, I would have 38 minus 28 minus 14, which would come to negative 4,000. That's my CFI. The final step would be my CFF. No other long-term assets, so nothing else going on in CFI. My CFF is a little interesting this time because I have a few moving pieces. Remember, from my balance sheet, these two are CFF items. CFF, 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 CFF. So we got a lot of stuff to look at. First, start with notes payable. I know that my notes payable account started at a balance of $10,000 and ended at a balance of $3,000. Well, I could assume that I paid down $7,000, but that's not necessarily the case. And if I issued any other notes, then I would have to account for that. Now, I didn't issue any other notes, not to pay off or not to pay for the plant assets. Remember, I said I used long-term bonds payable. So that doesn't affect my notes payable. I paid off $8,000 of long-term bonds payable. Again, that doesn't affect my notes payable. So in this case, yeah, I can assume that I paid this down. When I paid down note payable, that would be with cash, a credit to cash. So the credit to cash shows a cash outflow, and I would have a reduction of $7,000. And that goes into my cash flow from financing activities as an outflow. Now, the next stop would be dividends. I'll wait to look at retained earnings, so we'll hold on to that. Long-term bonds payable, I had some extra information. I said that in this case, for long-term bonds payable, for these bonds, they started at 90. They ended up at 107. I know I had a flow here when I purchased the plan assets. That increased them by 12K. I also said that I paid off 8,000. All right, so I have a payoff of 8 then that must be an outflow from cash flow from financing activities because I'm paying them off, debiting those, crediting cash. But this still doesn't balance to 107. 90 plus 12 is 102. Minus 8 would be 94. So that must mean that I also issued some. So I have a $13,000 missing amount here. This would be a bond issue. That means that I would have an increase to my cash flow from financing activities. So I have two effects on my bonds. Again, just reconciling what I've listed before here as a 12K, the extra information saying I paid off 8,000, and then an extra 13,000 from reconciling this information and noticing that it only comes to 94 when I need to be at 107. So I have a payoff or retirement of bonds for 8,000. I have a bond issue, which means I raised money with issuing bonds for 13,000. And now I can move along. The next item would be my common stock and APIC common stock accounts. Well, this one went up by 30. And the next one went up by a substantial amount more. Looks like 89,000. Now is all of this cash? Typically, I would just say, oh, credit this, all of that is cash. But we know we have a non-financing activity, non-cash activity with that equity. So it went up overall by $119,000. But 4,000 of that was a non-cash activity. So that means that $115,000 must have been cash flow from the financing activities, which means that I issued stock for $115,000. What else do we have here? The final item. Look at your retained earnings and determine if any dividends had been declared. My retained earnings goes from 45,000 up to 59.5. We know that 19,500 of this came from my net income. And so that means that they declared dividends of 5K. But did they pay those? I have a dividends payable account. That dividends payable account started at 2,000, went up to 3,000. If I know I declared dividends of 5,000, that would have increased my dividends payable by 5,000. Those two entries are connected. And then 7,000 altogether, but I have 3,000 remaining. So that must mean that I paid dividends of 4,000. Again, reconcile these flows to a total. That should come out to $109,000 of a cash inflow. We add up our outflow, inflow, and we get a total cash flow that would equal, again, the difference between my two items of cash, where we want to check. So that total cash flow, when you add those up, that would be 51,500. 51,500 subtracted from 109,000 gives me $57,500 of total cash flow. That total cash flow correlates perfectly to the amount of cash that I show in the balance sheet. Okay. So 2 very comprehensive, very complex examples for you to work through, for you to understand. If you don't even understand these, don't ask me for another cash flow statement question. I will give you another one. I will make up another one, but you got to work through these and understand them. Don't just see if you got the right or wrong answer. That's not going to cut it. Don't just scrap something because you didn't get it right. You got to work through the process and understand why you didn't get it right. And then you can really figure something out about how to fix it. Okay. If you have any questions about these in class, bring them up first thing in class and we'll talk through it. Thanks.